For what it's worth, I have seen you walk into banks wearing shirts that are less attractive than the one you're wearing now.
That's usually once the relationship has been established.
Fair enough.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst pour out old fashioned real estate advice.
Episode 18.
Good afternoon. Welcome back to the Old Fashioned Real Estate Show. I'm Brian Leverage.
And I'm Jeffrey Holst.
And we look forward to discussing a great topic with you guys today. Most people, common question that we get is, how do we get financing on our properties, right? Would you say you probably get that question more than anyone?
And we did do a video about this, which I'll tag here, where we talked about different ways to get into investing that's sort of related to this. But today we're going to talk more about bank financing in particular.
Exactly. And so specifically, banks are generally the preferred method of borrowing capital rather than other alternative sources such as, private money, equity, et cetera.
And why would you say that is?
Well, they're highly regulated. So generally there's a pretty strict network of rules in place that governs what they can and can't do in certain situations. Also, they have cheaper interest rates than you'll get in the private market.
Probably because of the regulation. Because honestly, regulation doesn't appeal to me as an individual.
Nor I.
But
That's another show, though.
Right. Maybe not even an old-fashioned real estate show. That might just be like Brian Leverage on YouTube show. But the point is, I think that banks are a good source of money that are accessible to many people as long as they follow the procedures that we're about to lay out.
And some of what we're going to get into is pretty common sense, and some of it is a little more informational. First thing is when you move into a market, whether you're investing or maybe just looking to buy your own house, you're going to set up meetings, and you want to talk to probably several different lenders at a minimum. And why would we do that?
Well, you never know. I mean, which banks are going to be lending on the type of property that you want, and also the banks that are lending at one point in time might be different in a different point in time. I think when you're setting up those meetings, and maybe you were going to mention this, but it's important to reach out to other real estate investors as well and find out who's lending on the type of property that you're interested in.
Right. The first thing is, as everybody knows, you never get a second chance to make a first impression. So when you do have that meeting, dress the part. Bankers are typically, well, not all bankers, some, but not all.
They're a little on the stodgy side.
Yeah, they're wearing suits and they're dressed very formal. So you need to look more or less like they do when you show up. So don't dress like me wearing my semi-tropical shirt that I picked up in Bali on my honeymoon and flip-flops and board shorts.
So that's a really old shirt then.
It is. So am I, though.
Yeah, that's fair enough.
So, more importantly than that.
For what it's worth, I have seen you walk into banks wearing shirts that are less attractive than the one you're wearing now.
That's usually once the relationship has been established.
Fair enough.
Number two would be come prepared. And what that means is have a plan, okay? You're meeting with somebody that you want to lend you tens of thousands, hundreds of thousands, or in some cases millions or even more, okay? So what's your plan look like to them? It needs to impress them. What are you wanting to accomplish, in other words? Okay?
Yeah, basically I think what I consider is you want to make their job as easy as possible. Yeah. You want to understand the kinds of stuff that they need, like personal financial statements, tax returns, and also a summary of your experience. Because if you're going to go borrow, on your first house, it's one thing. But if you're going to go buy an apartment complex and you want to borrow millions of dollars, they need to see that you or your team have the experience in what they're doing. Because a lot of that is dependent on your experience.
And having those things ready on the front end when you go into your meeting is really great at making a positive first impression.
Yeah. I mean, the best borrowers that I know, I'm not nearly this organized, but the best borrowers I know have like a binder or a Dropbox folder or something that as soon as they meet someone, they can say, hey, this is all my stuff.
Yeah.
Even if they're not looking for a loan right now, here's my stuff, put it in your file, and that way when I do need a loan, you've already kind of pre-vetted me.
Exactly. Now, some of the things that lenders are looking for when they take a look at you as an individual, potential borrower is they're going to look at your liquidity. That is, how much cash do you have, or, stocks, things that can be easily converted to cash in a very short time frame. So liquidity is of great importance. Income would be another one, right?
Sure.
They want to see that you actually can hold a job down, and that also goes towards your ability to cover the debt on your own if the project doesn't work out like you hope.
Right, and we can put some of this stuff in the show notes so you kind of you don't have to be writing this all down. But I do think that one thing to think about is to just ask the bankers what information they need, because a lot of people are hesitant, or the bankers will call you and say, hey, I need this, or I need X, Y, and Z, I need a liquidity statement, I need proof of funds, I need whatever it might be that they need. And whenever they ask you for anything, whatever it might be, you need to get it to them right away. You want to make the theme is make their job as easy as possible, so they want to lend to you.
They're also going to take a look at your credit, which means they'll pull your credit report. Credit score, generally, the higher the score, the better it is. Okay, so things like past foreclosures or delinquencies on credit cards or automobile payments or even student loans will all negatively impact your score. That affects the bank's decision on their ability to give you credit. And if they do give you credit, you could expect to pay a higher price because you represent a higher risk to them for that. Also, as important as all these other things, but less commonly thought of, is experience, right?
Sure.
Generally, you don't want to go into a bank with very little in reserves and everything else and say, I want to buy a $5 million apartment building. You probably have a pretty difficult time getting that loan without having some type of a track record along those lines.
No, even with a track record, if you don't have any reserves, you might have trouble getting that loan. But, I mean, there is a difference, right? When you're buying a $5 million apartment building, they're going to underwrite the project a lot more. If you're buying a single-family house to rent out, they're underwriting you.
They're going to look at you.
I mean, they want the value of the property to exceed the amount of the collateral has to exceed the value of the loan, but they're more concerned with your personal ability to pay back than with the project. Right. So that's where experience is useful. But when you get to the apartment level or the expensive commercial property level, experience is actually essential. It's impossible to get those loans without experience.
Like anything else, though, there's also a bit of a workaround where if you lack some of these things, if you're just getting started in your investing career, you could partner up with somebody that is stronger on paper or maybe has a little bit of that experience.
Right,
too.
and in fact, when you get into the apartment world, there are people called key principals that sort of specialize in taking a little piece of your deal to be the guy that's on the hook, essentially.
Guarantor.
Yeah, and if even in the non-recourse, they can be the person that takes the experience component out, or the liquidity or the net worth components out. Because when they give you non-recourse loans, even though they only go after the property and not you individually, they still require you to have a certain amount of net worth, a certain amount of liquidity, and then definitely a lot of experience. So those people can be very valuable to you. And
we kind of touched on this a little bit earlier, but circling back on it is you want to develop relationships with as many banks as you can. And there's, a couple reasons. Again, we're sort of reiterating here. Some banks specialize in certain loan products or niches. For instance, some banks might prefer to do construction loans on developments or vice versa, going back to the apartment example.
They might just offer something that the other bank doesn't. And it might even be a temporary program, right?
Yeah.
So
lower down payments compared to some other banks, depending on the circumstances.
And that can make a huge difference, right? Brian and I bought a building last year that we were able to get in with only 10% down.
That's right.
And the difference between 10 and 20% down can make a huge difference in your cash-on-cash return because you put in half as much money.
Turbocharges it.
Or doubles it at least.
That's still fast. So the other reason too, though, you want to have multiple lending relationships is you're trying to mitigate your own risk. If you have all your eggs in one basket with one bank, if that bank gets bought out or acquired, their loan policies might change. And while you may have fit their model previously, you may no longer fit in that model.
And they may just change it for no reason that's apparent to you. And also, I think something that people don't often think about is sometimes they have a certain amount of loans that they're willing to do in a calendar year or in a quarter. And you might be in December and they might say, no, we can't do anything like that. And they might call you on January 5 and say, hey, do you still have that loan? I want it. And you just never know what banks are going to do what at what time.
That's exactly right. Banks, as we mentioned, are heavily regulated. And that means they have regulators that come and look at their books and determine you can lend so much in A asset class and B
and to
C,
individuals,
and
right?
So,
so you can hit a maximum lending limit for an individual. Some smaller banks, you might only be able to borrow a few $1 million and then you're done. They can't loan you anymore even if they want to.
And sort of piggybacking on this, you want to have the right project, right? As we sort of jokingly said earlier, without income and assets, you're not going to walk in the front door of a bank and get a $5 million loan on an apartment building. But on a more serious note, whatever project it is, you want to make sure that the numbers work, and you need to be conservative about that.
Right. Well, if your apartment building is only worth $4 million, it doesn't matter what your assets are. You're not getting a $5 million loan on it. And the value is going to be determined by whether it can meet the metrics that the bank wants to pay.
So you should use your own expense ratios when underwriting these things. Try to be a little more conservative. Don't ever massage the numbers to fit a particular outcome. The lenders will, on the other hand, use their own numbers in
which will
determining
probably
the underwriting.
Be even more conservative than yours in a lot of cases.
Yeah.
But sometimes they're just frankly wrong, right? They have certain rules like we're going to assume 10%. It's different for each bank, but we're going to assume 10% management costs, for example, and you might know that you can get it managed for 5 or 7%, but if the bank says we're going to charge you 10%, that's the number they're going to use in their underwriting when they determine things like loan to value and debt coverage ratios and things like that.
And so a debt coverage ratio, great segue, is it's basically just
I had your notes.
It's a measure of a property's ability to carry the debt load after the expenses are backed out of the income. So you have your net operating income, and that's then divided by the mortgage payment. And lenders are looking for, usually at a minimum, about 1.25.
And it depends a lot on the situation, right? So sometimes they'll, if you're doing a value add situation where you're showing them raising rents, they might say, hey, we want 1.1 the first year, 1.2 the next year, 1.3 the third. And we've actually done loans like that. Sure. We had one loan where the bank wanted 1.2 to start with, and they wanted us to get up to 1.5. Now, that was an equipment loan, but I mean, the same concept applies. They put those covenants in. It says how they want to do it. But just to be clear on the debt coverage ratio, it is literally just a ratio of debt coverage. I mean, that's what it says. So if your property makes $150 a year and your debt costs $100 a year, you just take $150 divided by 1 and you have 1.5 debt coverage ratio.
Then the last one is just the lenders are going to use loan to value to determine how much they're going to lend. So they'll order an appraisal from an independent appraisal company. They'll come out, that appraiser will assess the property and provide an opinion of value in several different circumstances. Most banks will do 80%, some will go a little bit higher, again, depending on that situation. If it's a value add, they might go as high as 90%. But, those are the metrics that they're generally using.
Right. And the loan to value thing is really interesting because there are different ways that you can value things. And I think this is a great segue because in our very next episode, which comes out 2 weeks from today, assuming you're watching this as it comes out, we're going to talk a little bit more about how appraisers come up with value, particularly in commercial properties and capitalization rates.
And won't that be interesting?
Oh, this is going to be the best episode yet. Every episode we have is the best one we've done yet, just so you know.
Well, I think that about covers it for today. We appreciate you joining us and look forward to seeing you again.
And be sure to subscribe. Thank you very much.